December 28th, 2025, 10:18 p.m. Eastern Time. Something historic just happened in the silver market. Not quietly, not gradually, not buried in fine print, but unmistakably. Tonight, silver touched $85 per ounce on the Shanghai Futures Exchange. At the exact same moment, the COMEX paper price in New York sat at $79. Read that again. 85 versus 79. A $6 gap. In a market where arbitrage is supposed to erase price differences measured in pennies, this is not noise. It's not volatility. It's not a temporary glitch. It's a structural failure. And it may be the clearest signal yet that the paper silver market is losing control to physical reality. Markets can tolerate small inconsistencies. They can tolerate sense. They can tolerate friction. They can tolerate timing mismatches. They cannot tolerate persistent dislocations. A $6 gap between East and West is not a rounding error. It's a verdict. Because silver is not oil. It is not wheat. And it is not infinitely fungible when inventories are thin. Tonight, the market delivered a very specific message. The price to secure real deliverable silver is $85. Everything else is accounting. To understand why this matters, you have to accept a hard truth. Silver no longer trades in a single market. It trades in two, and they are rapidly pulling apart. In Shanghai, silver trades as a physical commodity. The exchange is built around delivery. Contracts are written with metal in mind, not leverage. Industrial buyers don't show up to speculate. They show up to secure supply. Solar manufacturers, EV producers, electronics firms. They're not chasing price action. They're locking in metal they actually need. Shanghai prices reflect what it costs to get silver in hand right now. New York is different. COMEX is a paper market. More than 97% of its contracts never result in delivery. They're rolled forward, offset, cash settled, netted out. Price discovery there is driven by leverage, not availability. That system works until it doesn't. And tonight, it didn't. In a normal market, this gap would vanish instantly. Traders would buy silver at $79 in New York, ship it to Shanghai, sell it at $85, and pocket the spread. That's how arbitrage keeps markets honest. That's how prices stay aligned. Except arbitrage requires one thing above all else: metal. And the metal isn't there. COMEX registered inventories are already thin. Every attempt to exploit this price gap doesn't fix the problem. It exposes it. Each arbitrage trade drains vaults further. Each delivery request tightens the noose. Each successful shipment makes the next one harder. That's why the gap didn't close. Not in minutes, not in hours, not overnight. It persisted. And persistence changes everything. Failed arbitrage isn't a pricing issue, it's a confidence issue. It tells us that physical supply can't meet financial promises, that paper claims exceed available metal, that the delivery mechanism itself is under strain. This is the phase markets enter before repricing turns violent. History is clear on the sequence. First comes physical tightness, then paper denial, then widening spreads, then loss of confidence, and then, suddenly, repricing. Not gradual, explosive. And the distortion isn't just geographic, it's historical. The gold to silver ratio now sits near 50-1, wildly out of alignment with 2,000 years of monetary history, where the average ranged between 10 and 15-1. Every single time the ratio stretches this far, it resolves the same way. Not with gold collapsing, with silver surging. Violently, we've seen this movie before. In 1980, again in 2011, and in both cases, silver didn't grind higher. It erupted. Parabolic moves, vertical charts, panic buying. Skeptics always respond the same way. This has happened before. They're right, but they're missing what makes this moment far more dangerous. Silver is now an industrial necessity in a way it never was before. It is embedded everywhere. Solar panels, electric vehicles, 5G infrastructure, AI data centers, military and defense systems. And the most powerful driver of all is unfolding quietly inside the solar industry. TOPCon technology. TOPCon solar panels use 50 to 80% more silver per unit than previous designs. Manufacturers can't substitute. They can't redesign overnight. They can't shut factories down. If silver prices double, production doesn't stop. Margins compress. And price inelastic demand is lethal to paper markets. Then there's supply, and this is where the fantasy finally ends. More than 70% of global silver production comes as a byproduct of copper, lead, and zinc mining. Silver output depends on other metals being profitable. Higher silver prices do not magically create new supply. Primary silver mines take 10 to 15 years to develop. Exploration has collapsed. Ore grades are declining. Permitting is slower than ever. Recycling recovers less than 20% of used silver. The supply curve isn't flexible. It's rigid. And rigid supply, combined with accelerating inelastic demand, leads to only one outcome: a price shock. Tonight's $85 print in Shanghai isn't an anomaly. It's a warning shot. The paper market is losing authority. Physical reality is asserting itself. And when that handover completes, it won't happen politely. It won't happen gradually. It will happen all at once. What's happening right now exposes something fundamental, something uncomfortable, something the paper market depends on, but rarely has to defend. Confidence. COMEX only works as long as people believe in it, believe that contracts can be delivered, believe that settlements will be honored, believe that somewhere, somehow, the metal exists inside the system. Paper price discovery isn't anchored to metal. It's anchored to trust. And when physical buyers stop believing that story, they don't argue. They don't complain. They don't wait for clarification. They walk away. And that's exactly what's happening now. Shanghai is becoming the price setter, not because it's bigger, not because it's louder, but because it's real. The $85 price reflects delivery stress. The $79 price reflects financial denial. One market is asking, what does it cost to get silver right now? The other is asking, what do we need the price to be so the system keeps functioning? Markets can ignore reality for a while. They can smooth it over with leverage. They can mask it with volume. They can postpone it with settlement games. But they cannot ignore it forever. And when confidence finally breaks, COMEX doesn't slowly rise to meet Shanghai. It gaps. Repricing never arrives politely. It doesn't climb $1 at a time. It doesn't wait for analysts to update models. It doesn't give shorts time to exit calmly. It arrives in jumps. $4, $6, $10. Sometimes in a single session. Because when shorts rush for the exit in a thin market, there's no depth waiting for them, no bids, no buffer, no safety net, only air. This is the late stage of a squeeze, and every commodity squeeze follows the same script. First, physical tightness appears. Then paper markets dismiss it, spreads widen. Arbitrage fails, confidence erodes. And then repricing turns violent. We are no longer early in that sequence. We are no longer debating theory. We are at the stage where confidence is cracking. And once confidence breaks, there is no controlled exit. That doesn't mean the move will be smooth. It won't. There will be sharp pullbacks, engineered sell-offs, sudden volatility spikes designed to restore order. Paper markets always fight to survive. But understand this. Volatility isn't weakness. It's stress made visible. And stress is now everywhere. In spreads, in inventories, in delivery mechanisms, in arbitrage failures. The system is straining for investors. This moment isn't about day trading. It's about positioning. In structural breaks like this, the vehicle matters more than timing. Physical silver removes counterparty risk entirely. Mining equities offer leverage, but demand conviction. Paper instruments rely completely on trust and settlement. Choose intentionally, because the window is closing. Most people won't understand what's happening until the headlines start screaming. By then, the price gap will be gone. Metal will be unavailable, and the price will already reflect scarcity. That's how asymmetric opportunities always unfold. Quiet first, violent later. And this isn't just a silver story, it's a trust story. Trust in paper claims, trust in financial settlement, trust in Western market structure. Once that trust erodes, repricing doesn't follow because of emotion. It follows because of physics. So let's be clear. $85 in Shanghai is not a fluke. It's the real price. $79 in New York is denial. The market has spoken, and it's speaking louder every day. This isn't a chart pattern. It isn't a technical setup. It's a regime change. And when physical reality collides with paper leverage, physics always wins. If this helped you see what others are missing, like the video, share it and subscribe, because this story is unfolding in real time. And when the paper market finally breaks, it won't ask for permission.